Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Chris Englebert, founding partner and CIO of Englebert Advisors, to discuss how retail investors and advisors are positioning for 2021. Chris, it's great to see you. Welcome back to Trade Talks.
Thanks, Jill. Thanks for having me. Great to see you again, too.
And since we last spoke on October 30th, the election overhang has been removed. We've gotten positive vaccination news, sending stocks to record levels in November. From an investing perspective, what's your outlook for the remainder of 2020 and going into 2021?
Yeah, Jill, any of our viewers, if they remember what we were talking about the last couple of months, we said that any market pullbacks before November, before the election, had to be bought. There was $15.5 trillion sitting on the sidelines. $800 billion came in the last couple of weeks. And so obviously the month of November was one of the best months, up over 10%. Right now we're in December. We got the Nasdaq at new highs. We got the S&P. We'll talk about that some more. And the Russell. So everything looks really good right now. Our indicators are stretched at this point in time. We see some complacency there, but the seasonal trade is on our side. December has been historically one of the strongest months out there. Now let's talk about 2021, because everybody wants to know what we think is going to happen next year. And we think there's really three major themes. And the first one is going to be interest rates. We think interest rates stay muted the first half of the year because obviously people are concerned about the virus firing back up, the lockdowns, et cetera. And we think you're going to see a lot of companies push out their earnings recovery to probably 2022. But I'm much more concerned about interest rates the back half of 2021. We think they're kind of like a balloon underwater. We'll again look at the charts in a minute, but you could easily see the 10-year Treasury. I mean, last year at this time, the 10-year Treasury was almost 2.5%. We think the back half of the year with inflation, you're going to see the 10-year Treasury, obviously trade higher. We think there's a rotation. You and I have talked about this before, from growth stocks, the work at home stocks, or the work from anywhere stocks. That trade's a little long in the tooth. It might have some more to run, but believe it or not, there's a stealth value rally going on. And we think one of the benefits of the value stocks is that you're beginning to see a lot of these companies issue good guidance and earnings. The reason being is they're using technology. There was a oil drilling company that issued some good earnings a couple of weeks ago, and they said, hey, we're invoking big data, et cetera. And then finally, the other theme we think that continues on next year is everybody loves acronyms, the beach trade. We had the FANG trade, Facebook, Apple, Amazon, Netflix, NVIDIA, and Google. Now we have the beach trade. And we think that flows into our revenge vacation theme. The beach trade is bookings, entertainment, airlines, casinos, hotels. We think that if somebody's going to book a trip, you better do it now, because with that positive vaccine news, everybody's going to be booking trips next year, and people may be surprised.
Yeah, Chris, it'll be interesting to see what productivity is with all the different desks and all through America, because all of us are jonesing to go away, right? So the back half of the year, what if it'll be a ghost town, right, in the office? So what did you learn as an advisor in 2020, and where should RIAs be focused for 2021?
Yeah, that's a great question, Jill. And what we really learned in 2020, and again, you and I have talked about this over the last couple of months, is that anybody that made a big asset allocation change, it really taught investors and advisors to focus on people's long-term goals. And we saw this in February and March when there was the big sell-off. Some people panicked. I'd heard from a money manager that he got a call from an advisor who said, sell my clients out, I don't want to be in. Well, obviously we know that was a huge mistake. And then again, before the elections, you had a lot of people going, oh man, I'm going to be sitting on cash because I don't know what's going to happen. If you have a long-term plan, stick with it. And I think what advisors really need to do is communicate, with their clients what the long-term plan is. And there's going to be obviously ups and downs, and it doesn't mean you don't make any changes, because right now, the last couple of months, we've been shaving our large cap growth positions and rotating into value. But what it really taught us was that, advisors have to have clients stick with their plan. And I think the other thing that we are learning in 2021 is that if you're an advisor, you got to embrace technology. You got to do Zoom calls. It's becoming the normal. We're going to start firing up our own webinars. We're going to be doing one in December, one in January, February, March. I mean, there's a lot of webinars that are going on intra-company or between companies, but a lot of retail investors aren't getting, communicated to via webinars, and they're really, they're really comfortable with that now. And so I think that's good. And I think the other thing that a lot of advisors have to do is they got to write a book. We wrote a book last year. We got 2 books that we're going to be writing this year. A lot of advisors have a lot of knowledge. They need to get that down because they can use that to communicate and market to their clients. So those are some of the things we learned, and we were able to really focus on those things kind of in a short time period. And I think they're going to be very impactful the next couple of years for RIA firms.
Yeah, that's a great point that you make about Zoom and doing the webinars. I mean, think about what it's done for investment companies, broadening your investor base because you have access to a more diverse audience than you would have if you would have just marketed to the same kind of people. So I think that's a great idea. It's more accessible for everyone. Chris, Let's go to the charts. Let's talk about the S&P 500. As you had mentioned, we're at all-time highs. What's next?
Well, it doesn't mean we can't go higher. I mean, a lot of people get uncomfortable and they say, wow, the market's, really, well, again, it's a function of interest rates. And if you, do your capital markets pricing, I won't bore our listeners with that, but could the market go another 10 to 15% higher? Yes, absolutely. So, we're not really afraid of all-time highs. We saw consolidation in September and October, and then we broke out. I do think that you could end up getting some consolidation because, we had such a sharp move in November into December that I would not be surprised. I mean, we are going to get into the seasonal aspect where trading volume starts to decline towards the end of December. So short term, I'm looking, we're a little over, our risk indicators are a little elevated. We could get a small pullback or so. I'm looking for some consolidation, but again, the trend is really your friend.
And with the Nasdaq 100, I mean, it continues to hit new all-time highs. And it's interesting when you talk about the growth value trade, when you think about the constituents of the Nasdaq 100, these kinds of companies aren't going anywhere. They're driving the new economy. So, the growth value might be a trade, but what do you think longer term with the Nasdaq 100?
Yeah, I'm glad you brought that up because something I'm really fired up about is, and I'm not just saying that because we're on the Nasdaq, but the Nasdaq has literally been at the cutting edge of developing some of the best indices out there. And one of the ones that we're very excited about is the Junior Biotech Index that came out back in June. We've been focused on that. We are looking at that very closely. We've actually been running some portfolios with those companies in them. We think that's the next big trend. And the NASDAQ, again, obviously it's a commercial to the NASDAQ, but we think that the NASDAQ is at the forefront of bringing the next wave of stocks. And that junior biotech stocks, there are companies there that are similar, and this is not a recommendation to buy or sell, but similar to Amgen, Biogen, some of these, old, I hate to call them old line biotech companies, but biotech companies that were $20, $30 a share, they're now $300 to $400 a share. We think that there's some areas in the NASDAQ that are really under-owned, that there's been a tremendous amount of money on the sidelines looking to come in, and it's going to come in through those different sectors, and the NASDAQ's at the forefront of it.
Yeah, Chris, you should also do a little bit of homework on QQQJ. That's out of Invesco. It's the next Nasdaq 100 stocks. I think that's going to be a really interesting ETF to watch, especially if you like to see a little bit of volatility within your portfolio. So let's move along to the Russell 2000. Of course, this one has been highlighted through November, having a tremendous month.
Yeah, this has been probably the biggest benefactor of the vaccine trade, because those companies were kind of held back. Nobody knew when they're going to reopen, et cetera. And you could tell in November when the money came into the market, everybody was looking for a bargain, and the Russell 2000 was one of the best places to be. And also to kind of back up, like what we were saying about the biotech index and the next generation of NASDAQ stocks, that could be the other theme for 2021 that we've been looking at very carefully, is the small mid-cap stock trade has been not doing very well literally the last 7 or 8 years. And the big surprise in 2021 could be the resurgence of those small mid-cap stocks, because they end up becoming much more efficient through A, technology, and B, integrating their business from that standpoint. So we're excited about that small mid-cap space where the baton ends up being handed off to them.
Well, Chris, let me ask you about oil, because that has continued to make a run as well. It's not like demand is any different than it was, 2-3 months ago. The corporate travel certainly isn't back. So what's pushing it higher?
Really the weak dollar. I mean, there's a lot of trading that goes on, people don't understand, on a global basis, and there's arbitrage that goes on all the time. If you look at the chart of the dollar, we should probably include it in next time, it literally has been in a free fall for the last almost 4 months, maybe 5 months. I don't know if it's going to turn anytime soon. but that's really been what's pumping up oil. And the question is it a trade? Is it ongoing? One of the things I've learned in my vast experience about trading currencies is that once a trend is established, it tends to stay around for a long time, usually multiple months. So a weaker dollar obviously helps the U.S. oil market. That's really what's driven it back up. The question is, like you said about demand, I think it could be more the back half of the year before demand really begins to reaccelerate and maybe supports these prices. But right now, we're more sanguine on oil prices than anything else.
All right, Chris, and to wrap up here, the 10-year Treasury, you touched on interest rates earlier in the interview, but what's your thought longer term 2021? Yeah,
longer term, again, we're very bearish on interest rates. I mean, again, it's like a balloon underwater. We think that, the whiff of inflation in the back half of the year could send rates up sharply, much more than what people understand. I included that chart in there, and I drew a line at the 1% rate. Once we've reached the 1% rate, you could quickly go to the 2% rate. Literally within, weeks. So we think that there's a lot of money kind of trapped in bonds right now, not knowing what to do. And we're sticking with the short end because our bigger fear is that inflation comes back and rates go higher.
All right, Chris, great to see you. Thanks for all the coverage this year. Happy holidays to you and your team. Thanks for joining us. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.